In this video, we're diving into an essential topic for any savvy investor: stock buybacks. What are they? How do they work? And what you should know to make informed investment decisions. So, what exactly is a stock buyback? In simple terms, a stock buyback occurs when a company repurchases its shares from the marketplace. This reduces the number of outstanding shares, often increasing the company's earnings per share and typically boosting the stock price. It's a popular strategy for companies to return value to their shareholders. Think of it this way: if you believe a stock is undervalued, you might buy more of it, expecting its value to rise. Corporate executives do the same. When a company buys back its stock, they're essentially betting on themselves, believing their stock is worth more than the market currently values it. But why do companies engage in stock buybacks? Let's explore some of the key reasons. First, buybacks can be the best use of excess capital. Instead of sitting on large amounts of cash, companies can reinvest it in their own stock, which they believe is undervalued. Second, buybacks can help increase the share price, especially if the company has been undervalued due to negative news or market conditions. Third, buybacks improve key financial metrics. For example, they increase earnings per share and return on equity, making the company look more attractive to investors. Let's take a look at some real-world examples. Tech giants like Apple and Microsoft are well known for their buyback programs. Apple, for instance, announced a massive $100 billion buyback program in 2018, significantly boosting its stock price and earnings per share. But it's not just tech companies. Retail giants like Walmart and Target have also launched significant buyback programs. Walmart spent over $67 billion on buybacks between 2008 and 2018, increasing its dividends per share and overall growth. Now, how do companies actually execute these buybacks? These are a few common methods. First, we have direct repurchases. Here, a company makes a tender offer to shareholders to buy back a specific number of shares at a predetermined price, usually higher than the market price. Second, companies can buy back shares on the open market just like any investor would. This method has become popular recently due to regulatory changes that make it easier. Another method involves tender offers and Dutch auctions, where companies specify a price range and buy shares at the most favorable prices within that range. Let's break down these methods a little further. In a direct repurchase, the company announces a tender offer, specifying how many shares it wants to buy and at what price. Shareholders can choose to sell their shares back to the company at that price. This method is straightforward, but often requires the company to pay a premium above the current market price. In the open market approach, the company buys back its shares through the stock exchange, similar to any other investor. This method allows the company more flexibility, but can drive up the stock price, making it more expensive to complete the buyback. Tender offers and Dutch auctions are more targeted. In a tender offer, the company specifies the price range and the shareholders submit how many shares they're willing to sell and at what price. The company then buys back the shares at the lowest possible price within that range. Dutch auctions work similarly, but allow for a more dynamic pricing process, with the company buying back shares starting at the highest price and working its way down until it meets its buyback goal. Now that we've covered the basics, let's discuss why companies opt for buybacks and what benefits they seek. One major benefit is improved financial metrics. Buybacks reduce the number of outstanding shares, which increases earnings per share and return on equity. These improved metrics can make the company more attractive to investors. Another benefit is the flexibility in capital allocation. By buying back shares, companies can return capital to shareholders without committing to ongoing dividend payments. Buybacks can also signal confidence to the market. When a company repurchases its shares, it often indicates that management believes the stock is undervalued and that the company has strong future prospects. But it's important to note that buybacks are not without their risks. Critics argue that buybacks can be short-sighted. Instead of using excess cash for long-term investments like research and development, companies might focus on boosting short-term stock prices, which can lead to the underinvestment in critical assets and potential long-term harm. Companies sometimes fund buybacks by taking on debt, which can be risky. If the company's financial performance falters, the additional debt can become a significant burden. Despite this, buybacks can remain a popular tool for many companies. They offer substantial benefits when used wisely, but as an investor, it's crucial to understand the potential risks and evaluate each buyback on their own. So how should you evaluate a company's buyback program? Here are a few tips. First, look at the company's fundamentals. Ensure it has strong earnings, manageable debt levels, and a clear strategy for growth. Second, consider the long-term implications. Is the buyback part of a broader strategy to enhance shareholder value, or is it a short-term tactic to boost the stock price? Third, pay attention to insider behavior. If executives are selling shares while the company is buying them back, it could be a red flag. Finally, assess the company's overall financial health. Companies with strong free cash flow are generally better positioned to fund buybacks without compromising their financial stability. Thanks for watching this overview of stock buybacks. Don't forget to explore MarketBeat for more insights on the stock market and investment strategies. Happy investing.